I can hear you clearly. Good evening, sir.
Yeah, good evening. You're welcome again to another class on strategic business reporting. Today, we are going to be looking at IFRS 15, dealing with revenue from contracts with customers. This is a very important standard, and this standard is really a joint effort
Oh, wow.
between the IASB and also the Financial Accounting Standard Board. That is between IASB and the United States. So together they actually worked on this new standard on revenue. So this standard replaces IAS 18 and IAS 11. It's coming to replace those standards. And this standard actually comes to block a lot of loopholes that we had before under the old IAS 18. So it's blocking a lot of loopholes. So the first thing I need to mention when it comes to IFRS 15 is the objective of this standard. And the objective of IFRS 15 is to ensure, so this standard ensures that the revenue recognized in the statement of profit or loss depicts the consideration expected from the transfer of promised goods or services. So this standard major objective is to ensure that the revenue that is recognized in the statement of profit or loss depicts or reflects the consideration, the consideration expected from the transfer of promised goods or services. So, in summary, when you look at your statement of profit or loss, and we see a revenue of, let's say, 100 million, the meaning of that 100 million should be the money you are expecting from the transfer of goods or services, which basically means that you must have offered the goods or services. You must have delivered the goods or services. That is what we want to see as revenue. If you have not transferred the goods or services, you don't recognize revenue. That is what we want to see as revenue. If that means that if you are rendering a service and probably let's say you are expecting 100 million and you have, let's say, done like only 50% of that service, that means it's okay. You can recognize 50 million as revenue since you have transferred 50% worth of that service. That is basically every guideline we're going to look at in this standard. That's the objective, that is the aim. We want to ensure that the revenue that is recognized in POL depicts the consideration you're expecting from the transfer of promised goods or services. That's one. Now, the second thing is then, how do you then go ahead and how do you recognize and measure revenue? So, IFRS 15 came up with a 5-step model. So, a 5-step model is used for revenue recognition and measurement now. And what's this 5-step model? Meaning that there are 5 steps that must be achieved before you can finally recognize revenue. And the step 1 is that we must be able to identify the contract with a customer. Step 2, we must be able to identify the separate performance obligation. We must be able to identify the separate performance obligation. Step 3, we must be able to determine the transaction price. Step 4, we must be able to then allocate the transaction price to the separate performance obligation. And step 5, we must be able to then recognize revenue when the performance obligation are satisfied. These are the 5 steps that must be present. All the 5 must be present before we can finally recognize revenue. At least you can see that the final step is the step where we recognize revenue. And as it is today, you have to know these 5. You need to know it because that's the steps. So we have no other way than to be able to sit down and think of the 5 steps. Now, we're not going to go through each steps one by each and explain what is involved at each step, what must be present at each step. Then we would then have been able to do a very good job. Now, the step 1 in revenue recognition, we said identify the contracts with a customer. So the key item here for revenue is that we need to be able to identify the contract with a customer. So the key word is a contract. And a contract is an agreement between 2 or more parties that have legal and economic consequences. A contract is an agreement between 2 or more parties that have legal or economic consequences. And a contract is in IFRS 15 if it meets the following criteria. So before IFRS 15 can say that this is a contract, the criteria must be present. If the following criteria are not present, then it is not a contract. All of these five must be present before we can say, okay, this is a contract. And number one is that the parties to the contract must have approved the contract and are committed to the terms of the contract. They must have approved it, either orally, either in writing, either in any customary way in which contracts are approved in that jurisdiction. But the parties to the contract must have approved the contract. That's the first that we want to see before we can say, yes, this is a contract. The second one is that the right of the parties in the contract, the right of the parties to the contract must be identified. So each party's right in the contract should be clearly stated. You cannot just open or write or agree a contract that is not stating what you have to do. If you are supposed to deliver 1,000 quantity of goods, if you're supposed to deliver 2,000 barrels of oil, you see, the right of each parties must be clearly specified in the contract and identified. That anybody that sees it must be able to see it and agree that, okay, this is very clear. We know what each parties needs to do. So the right of the parties to the contract must be identified. Number three, the payment terms must also be identified. So we should be able to know when the buyer will pay, when the seller will receive his money. The payment terms should be identified. It's very important when it comes to revenue, when it comes to a contract. We need to be able to say that, okay, in the next 60 days, we'll collect our money. At the completion of the contract, we will collect our money. It has to be very clear. The payment terms must be identified in the contract. Number four is that the contract must have commercial substance. And when we say commercial substance, that is, there must be a change in risk, cash flows, and timing for each party. Commercial substance means that there must be a change in either risk, cash flow, timing. We must see that the parties are putting efforts. There has to be commerce. There has to be commerce. There must be commercial substance. We have to see that there is commerce. We have to see that there is serious buying and selling. Cash flows must change hand. Risk must be clearly be undertaken. Timing, people must be ready to give their time and effort to that contract. We have to be able to see that in that contract. Otherwise, it is not a contract. If we can't see somebody that is going to pay, if you can't see somebody that is going to offer goods or services, if you can't see somebody that is dedicating efforts, that means there's no commercial substance. That means there's no commerce. That means you guys are just joking around. So we need to see that the party are not so much related. No, not that related parties cannot do transaction, but we must see that somebody is paying somebody. We must see that somebody is delivering goods. Not whether you deliver or not, it doesn't matter. No, that's not commercial substance. Somebody must deliver. Somebody must be taking risk. Somebody must be parting with cash flows. Somebody must be putting effort. Commercial substance. And also is that it must be probable that the seller will collect the consideration it is entitled to. Okay, and there is another one which is like a repetition, is that the contract can either be in writing orally or in any customary practices obtainable in that jurisdiction. Again, you have to know this because I've seen your exam ask it. I've seen your examiner ask it for 10 marks, 8 marks. So that a contract is only allowed in IFRS 15 if it meets the following criteria. And you don't have to write it in this word for word like this. You just need to be able to know each of them, be able to mention each of them in their substance. At least you need to be able to tell us that they have approved the contract in whatever way you put it. You need to be able to know that each party's rights is specified. Each person knows what they are supposed to do. You need to be able to tell us that when payment will be received is specified, even if you don't remember payment terms. But I mean, the meaning is that when are they going to pay? The person that is supposed to pay, when will he pay? And there must be change in cash flows. People must be putting effort, time, risk, commercial substance. And the seller, it has to be probable that he will collect his money. It needs to be clear. If it is not probable that the seller will collect his money, you cannot recognize revenue. It's not a contract. And of course, the contract can be in writing, it could be orally, it could be in any customary practices obtainable in that jurisdiction. Nobody says that a contract needs to be in black and white. What is important is that there has to be an agreement that have legal and economic consequences. That is what is important. Okay. Now, do we have any comments or observations from any one of you at this point? Okay, if you don't, let me show you something. Let's look at a scenario. Let's put examples to this. Okay, Ifua, are you around today? No, you are even around because you are
Yeah,
going to give me some
yeah, good
work.
evening.
Oh, you're going to give me some work today when I'm editing this video. I have to remove that your now wow that you said at the beginning. I have to go and look for it because it was said while I was still talking. Oh yeah, I feel I read this first one.
Okay. Uh, Example one, valid contracts scenario. A manufacturing company, ABC Limited, signs a written contract with XYZ Corporation to supply 1,000 units of a product at 15 naira per unit. The contract specifies delivery in batches over 3 months. Payments to be made within 30 days after each batch is delivered. XYZ Corporation has a strong credit rating.
Okay, so it's just a scenario. I just wanted I want to put a scenario behind what a contract is. So the key thing is that would this contract between ABC and XYZ, can it be a valid contract? Okay, let's check it. Number one, have they approved it? Yes, because it is a written contract. So the parties have approved the contract because they have both signed. Both of them have signed. That means they have approved the contract. Number two is, what is number two? The parties' rights in the contract, is it specified? Okay. The right of each party is identified. That is the 1,000 units of a product to be delivered. So, I mean, we can see what the seller have to deliver. We know that, okay, this is what he has to do. Of course, why the other party would pay. That's clear. So their right is identified. Number three is the payment terms. The payment terms is also identified here. In this case, what's the payment term? Say 3 months period. Also, there is commercial substance. Because there will be a change in cash flow and risk. It's clear here because this guy is paying 15 naira per unit. Okay, this one is not this is not 3 days. So this is 30 months. This 30 days, not 3 months. The payment term is 30 days. And here we are told that XYZ has a strong credit rating. So XYZ, who is the buyer, he has a strong credit rating, which means that he will pay. So it is probable that ABC will collect its consideration because XYZ has a strong credit rating. So definitely the guy will pay his money. Okay, that's the first one. So as far as IFRS 15 is concerned, this is a valid contract. It's a valid contract. It meets all the key criteria. Now let's look at this second scenario, please. It says a software company, TechSoft, enters into a contract with a small startup, Newco Limited, to provide a custom software system for 100,000. The contract includes a 12-month development timeline. There's payment upon completion. Newco has a weak financial history and might struggle to pay. Okay, so you want to analyze this, whether this is a valid contract. The first one is we need to check is that have they approved the contract? Yes. Yes, the parties have approved the contract because they have signed it. Because they signed the contract. That's approval. That's more than enough approval that we require because they entered into a contract. So that's enough approval. Number two is that the parties' rights in the contract is also identified, which is to provide a custom software system. So the parties' rights in the contract is identified, that is to provide a custom software system. Number three, the payment terms. The payment terms is identified. That is payments upon completion. Also, the contract has a commercial substance because there is a change in cash flows and risk. Because somebody is paying, it's clear that this guy is going to pay 100K and somebody is taking risk here. Somebody is making effort. So there is clearly a commercial substance. Number five is that it is not probable. It is not probable that TechSoft will receive or will collect the consideration because Newco Limited has a weak financial history. Hence, this is not a valid contract and the entity cannot recognize revenue until a substantial sum is received from Newco Limited. So this is what we're talking about. Even though in the contracts, we can see all the elements, but because based on history, we can see that the financial history of Newco is very weak, which makes it doubtful that TechSoft will be able to collect consideration. For that reason, we say this is not a valid contract. It did not meet just one of the criteria. And you cannot recognize revenue until a substantial sum is received. Okay, now I need to mention something. Note that where a contract where a contract does not qualify under IFRS 15, but the seller has already collected the consideration under the contract, the seller cannot recognize revenue, but will recognize the amount received as a contract liability. This is very important for you. Very important that if you have a contract that does not qualify under these criteria that we gave, but you have collected money as a seller. See, that money, you cannot recognize revenue. You cannot say you have recognized revenue. What you can recognize is a contract liability. So, for example, now, let's assume you haven't transferred the goods or service. Let's say you have not transferred the goods or service, but you have collected money. You cannot recognize revenue in such case because you have not transferred the goods or service. You have only collected money. So that money, yes, in the double entry world, you debit bank, you cannot credit revenue. You cannot recognize revenue with such an amount. You call that a liability. It's a contract liability. To some people that are still using or that have the ideology of SCS, they will say you credit deferred revenue or deferred income. No, there is nothing like that. You actually recognize a contract liability in such cases. Okay. Now, do you have any questions before I move on? Ufama, please go ahead.
Well, like where I work, it's a
Yeah.
manufacturing company. Customers, they pay before production is being made, but at times when they have already paid, will not produce all the quantity they need. So in that case, how will you recognize that cash?
Contract liability. So that's a typical scenario of what you're talking about. Okay, so you put it in a contract liability until you have delivered. Until you have delivered. So it is when you have delivered, then you can then de-recognize that contract liability, then recognize it as revenue. So that's what we are
Hello,
talking about. Yes, my brother.
yes, sir. In this scenario, we do debit bank accounts, and the customer's account will be credited, standing as if we are owing them so amount. That is the way we do recognize it. But now with this
Yes, and that's
IFRS,
how I know.
but with this IFRS 15,
15.
now
Yes.
we still need to have a kind of account called contract liability and put all those customers' name underneath, so that at the time we are doing a report, definitely we have so much of customer money, but the good is yet to be delivered to them, so we are indebted to them. I don't know whether we are saying the same thing. Maybe it is the terminologies that it differs now according to IFRS 15.
Mm, okay. So yes, according to IFRS 15, you don't credit customer accounts. You credit contract liability. So that's the name of the account. That's how you should describe the account, contract liability. However, you see, IFRS is not rigid. So the fact that you have credited a customer account, for example, you credited customer account, if I were to be the auditor, I won't have faulted you, provided that if you are presenting your report at the end of the month, you present that customer account as a liability, and also on
Okay.
on the face of the account, you describe it as a contract liability. Then is in the notes, then you can, if you have many customer, so under that contract liability, you can then start listing those customers, then that's fine. So where I will not agree is in your statements of financial position, you now put that customer account as a receivable. Probably, let's say that customer is owing you before. You are now using that as a net off or something like that. So that's
Okay.
one. You have to present it as a liability. Even if you have written the name of the customer, it's okay. I will have just told you that, okay. But with this knowledge you have, just know that yes, it's okay, you can credit customer account, but when you're presenting your P&L, describe it as a contract liability. But with the knowledge you have now of IFRS 15, then the name of the account you should credit now should be contract liability. Then when you're describing that transaction, when you're describing when you're giving details of that transaction, I don't know which software you're using or Excel. So in that ledger, then you can then put the name of the customer. But the name of the account itself should be contract liability, right?
Under
Just
current liability.
yes, yes. So that's what you should be doing now going forward. That's what you should be doing now going forward.
Okay, sir. Thank you, sir.
You're welcome. Any other questions? Okay. Now, you see, if if one or more contracts, if one or more contracts is entered into at the same time with the same customer, with the same customer, the contracts can be combined if it meets the following criteria. So we're saying that if you enter into many contracts at the same time with the same customer, with the same person, we're saying that you can combine that contract and see them as a single contract if they meet this criteria. Number one is that the contracts are negotiated, the contract are negotiated as a package with a single commercial objective, meaning they have a single objective. They want to achieve the same objective. So it's just like where my wife works, they do advertisement, right? So when they sign contract with a customer, they can sign a contract with the same customer. They can sign a contract that, okay, we are going to help you do a video also, which is to create content. They can sign a contract that, okay, we are going to help you post this content and engage audience on social media, right? And they can also sign a contract to do maybe TV advert or something like that. So I'm just adding that. So let's assume those are separate contracts entered into with the same customer by the same entity. So we are saying that if you look at those contracts, you see the objective is to create awareness for a product, meaning that it has a single commercial objective, which is to create awareness. So when you have multiple contracts that are negotiated as a package, you actually negotiated them together. Just that now we are now having different contracts for each item, but they were negotiated as a package with a single commercial objective. Then you would likely want to combine those contracts and see them as one. Number two is that if the price of one contract, if the price of one contract is dependent, on the price or performance of another contract. So if the price of one contract is dependent on the price or performance of another, meaning those contracts are dependent on one another, that you cannot do one if you don't finish the other, then you probably are going to combine those contracts and see them as one. Number three is that if the goods or services in the contract can be delivered as a single package, if they can be delivered together, then we are going to see those contracts as one. We're going to put all of them together and see them as one. So these three criteria must be present before we can actually combine a contract and see them as one. So that's contract combination. Let me show you some scenarios so that it won't just be me talking grammar. Let me show you some practical scenarios. Now, if you look at this example, it says that a consulting firm, Advisory Limited, signs 2 contracts with a client, a 50,000 business strategy review, a 30,000 implementation plan. You see, both contracts were negotiated together, and strategy review directly impact on implementation. So you see, if I were to analyze and advise on this, see the 2 contracts should be combined and treated as a single contract because they are dependent on one another and they are negotiated as a package with a single commercial objective. So we should see them as a single. See, they are negotiated together and they directly impact one another. Number 2, a software company called TechSoft Limited enters into 2 contracts with a customer. Contract 1 is a software license for 100,000. Contract 2 is ongoing maintenance and support for 30,000 over 3 years. The customer is given a discount on maintenance only if they purchase the software license. So you will see that here, we are saying that we are going to give you discount on maintenance if you purchase software license. So if I will analyze this, I will say that the price of one contract is dependent on the price of another contract in the above scenario. Therefore, the contracts should be combined and treated as a single contract. Just because we are going to give the customer discount on maintenance only if they buy the license. So the price of one is dependent on the price of another. So it just meets one of those criteria. Number 3, a construction company, BuildCo, signs 2 contracts with a property developer. Contract 1, land, 500,000. Contract 2, construction of a building on the land, 2 million. The contracts were signed separately, but are part of the same negotiation. The customer will not buy the land without the construction contract, meaning that the customer is not going to buy the land from us if we don't agree to construct the building on the land. He's not going to even enter into any of the contract with us. So if I will analyze this, I will say the 2 contracts should be combined and treated as a single contract because the contracts are negotiated as a package and the price of one contract is dependent on the price or performance of another contract. So we'll combine the 2 of them as a single contract. Scenario 4, it says a machinery manufacturer, Machina Limited, enters into 2 contracts with a customer. Contract 1, sale of machine for 1 million. Contract 2, customization services to modify the machine for 200,000. The customer cannot use the machine without customization, and the two contracts were negotiated together. So the analysis here is that the contract should be combined and treated as a single contract because they are negotiated together and they are highly dependent on one another. So they should be combined. And the final scenario, it says an IT service provider, Cloud Tech Limited, signs two contracts with the same customer. Contract one, cloud storage services. Contract two, cybersecurity consulting. They say that the contract were negotiated separately, and the pricing of one contract does not affect the other. If I want to analyze this, I will say the contract should be treated as a separate contract because they are negotiated separately and their pricing are also independent. So we cannot combine these contracts in this case. See, all these scenarios that I'm giving over and over again, and I'm writing almost the same thing over and over again, you also have to properly go through that process so that you can get used to the fact that those criteria are important for you to know that when it comes to contract combination, you can only combine two contracts if they are negotiated as a package with a single commercial objective. The price of one is dependent on the price of performance of the other, or where those contracts can be delivered as a single package. You need to know those three. Even though for you to combine a contract, you don't necessarily have to meet those three, but at least one should be seen to have been met. Then you can combine those contracts together. Finally, under step one is contract modification. So contract modification, of course, when there is a change in the scope or price of a contract, then we say we have modified a contract. Now, when you have an existing contract, so an existing contract can be modified, and this modification will result in a separate contract if the following criteria are met. So meaning that when you change the scope or price of a contract, you have said to have modified that contract. Yes, you can modify, but can it result in a separate contract that we're going to treat that change in scope or that change in price as a separate contract. We can do that if the following criteria are present. Number one is that the change in scope in the contract is because of an addition of promised goods or services, meaning that the change in scope is because the customer requested for an additional goods. Maybe the contract before is that you're supposed to deliver 100 cartons of a product. Then the customer says, okay, I need additional 20 cartons. So that's one. Number two is that the change in price in the contract reflects the standalone selling prices of the goods or services. So we're saying that because of that change in scope, so the pricing of that change in scope must reflect the standalone selling price of the goods or services. And when we say standalone selling price, we mean the price that the entity will sell the goods or services as a separate product. That if they were supposed to sell these goods or service, that's the price they will have sold it to a third party. If they're supposed to sell it as a separate product, that's the price they will have sold it. Yeah, that's a standalone selling price. So if the change in price reflects a standalone selling price, then we should treat that modification as a separate contract. We should not modify the existing contract, but we treat it as a separate contract. That's contract modification. Again, let's see some scenarios so that we can bring home the point. It says a construction company, BuildCo, enters into a contract with a client for a building project at 500,000. During construction, the client requests additional features for an extra 100,000. The additional features are priced at market prices. So if I want to analyze this based on the follow-up from our discussion, I will say that from the above question, the contract's modification resulted in an addition of promised goods or services because the customer is requesting for an extra feature and the change in price reflects a standalone selling price because the additional feature are priced at market prices, at market rates. So following from the above, the contract modification will be treated as a separate contract. So this is what I'm talking about. So we're going to treat this as a separate contract because there is an additional feature requested and it is priced at market rates, meaning is a standalone selling price. Meaning if they were supposed to sell this additional feature as a separate product, it will have been priced at 100,000. So why then modify or adjust the existing contract? Because this qualifies as a separate contract. So we're going to see it as a separate contract. Scenario 2, say a company TechSoft signs a contract to provide accounting software for 50,000. After 3 months, the customer requests an additional inventory management module for 20,000, which is priced at a standalone selling price. Again, the contract modification will be treated as a separate contract because the change in scope is because of an addition of goods or services and the change in price is a standalone selling price. This one is more straightforward because it's clearly stated in the question. We are requesting for an inventory module and the pricing we are giving it is a standalone selling price. So we treat it, so we're going to have two contracts, a contract worth 50,000, another contract worth 20,000. Another one, a construction company BuildCo signs a contract to build 10 houses for 1 million. That is 100,000 per house. After 4 houses, the client requests 5 additional houses for 95,000 each, a discounted rate. So if I will analyze this, the change in scope is because of addition of goods or services, that is 5 additional houses, but the change in price does not represent or reflect a standalone selling price because it was given at a discounted price. Therefore, the existing contracts should be modified. So, and that's just because the cost of one house, if you are selling one house separately, is 100,000. That's the price to sell one house. But when the clients requested for additional 5 houses, we were selling it to the customer at 95, giving them at the discount rate. I mean, they didn't, I mean, from that information, that price is not a standalone selling price. That's the price, that's not the price we sell each of those houses. We sell them for 100,000. That means it doesn't meet the two criteria. So we will not treat this additional 5 houses requests as a separate contract, but rather the existing contracts will be modified. That's how that is going to work. Another scenario, a telecom company, Netcom, signs a 3-year internet service contract with a customer for 13 naira per month. After 1 year, the company offers a discount, and the company will pay 25 naira per month for the remaining 2 years. I believe you should be able to answer this, that the change in scope is because of addition of promised goods or services, but the change in price does not reflect a standalone selling price. Hence, the existing contracts will be what? Will be modified. We're not going to treat it as a separate contract. And finally, a consulting firm, Advisory Limited, signs a contract to provide financial advisory services for 100,000 over 6 months. After 3 months, the client requests an extension for 2 more months, but at no extra costs. The same analysis. So, the change in scope, yes, is because of addition of promised goods or service, but the change in price does not reflect a standalone selling price. Hence, the existing contracts will be modified. Okay, now we have totally covered step 1 when it comes to identifying a contract with a customer. So 3 things we looked at here. We looked at what is a valid contract. We looked at those 5 criteria. We looked at several scenarios just for those criteria to sync. We looked at contract combination, where you can combine contracts you entered into at the same time with the same customer. That can you combine them as a single contract? We said they have to meet certain criteria, so that if any of those criteria are met, then combine them and see them as a single contract. And finally, is contract modification. When there is a change in the price or scope of a contract, we said that you can treat that as a separate contract if the change in scope is because of addition of promised goods or services, and the change in price reflects a standalone selling price, then you treat that modification as a separate contract. Otherwise, you modify the existing contract, you adjust the existing contract. Any questions? Okay. Now let's go to step 2 of the 5-step model. And the step 2 talks about that we should identify the separate performance obligation. So you see a contract contains a promise to transfer goods or services. See, these promises are known as performance obligation. So when you have a contract, it will contain that, okay, I want to transfer goods or services to my customer. So these promises is what we call performance obligation. So these promises to transfer, let me put it in full, to transfer goods or services, that's what IFRS 15 calls performance obligation. So, you see, revenue are recognized separately for each performance obligation that is distinct, quote and unquote, distinct. So you recognize revenue separately for each distinct performance obligation. And that's why step 2 says that try to identify separate performance obligation. Just so that when you're presenting your accounts, each of those goods that you offer, you need to do a breakdown of them and recognize revenue on each of them separately. Don't lump them together. Like in a banking industry, for example, now, they have different bundle of services that they offer. When you check on the face of their accounts, they recognize revenue for each of those separate goods separately. Like when they give you loan, they get interest income. You will see interest income is a separate line on the account. When they help you process transfers, when you withdraw money from ATM, when you do all of that, they make money from fees and commission, separate service. When they engage in foreign currency transaction, they make some margins. They call that net trading income. Separate service, separate income. Each of those separate performance obligation, they see them as separate and they recognize revenue on them separately. And they are only separate. You can only recognize revenue on them separately if they are distinct. So when we say distinct, what do we mean? When is a performance obligation said to be distinct? So a performance obligation is distinct if it can be sold separately. If it can be sold separately because it has a distinct function and a distinct profit margin. It has a distinct function and a distinct profit margin, quote and unquote, distinct function, and also a distinct profit margin. When we say a distinct function means that the benefit that the customer can benefit from the goods or services on its own or together with other items that are readily available to the customer. It's just like when you sell a television, a TV set to a customer. You know that you can't just put a TV set and start watching. You need to connect it to a power source. That's what we mean by together with other items that are readily available to the customer. That everybody knows that naturally you need to have a socket, you need to have a power source before you can use the television, right? That does not mean that the customer cannot benefit from that television on its own, but it needs to be connected, right? Naturally. So a goods or service has a distinct function if the customer can benefit from that goods or service on its own. And secondly, a distinct profit margin, means that the goods or services is separately identifiable. So we are in step 2 of this IFRS 15, which is to identify separate performance obligation. And I'm taking you through a story, a sequence. And the sequence first is this, that when you have a contract contains a promise to transfer goods or service. And these promises to transfer goods or services, we call them performance obligation. And you see, the way revenue is recognized for each performance obligation separately, that is distinct. So you recognize revenue for each distinct performance obligation. And when we say distinct performance obligation, it means that the goods or the obligation or the goods can be sold separately because it has a distinct function and a distinct profit margin. And I'm trying to break that down further. That when we say performance obligation or goods or services has a distinct function, it means that the customer can benefit from that goods or service on his own. And it also have a distinct profit margin if the goods or services can be sold separately. That's when you can make profit margin on its own for that goods or service. If it can be sold separately, if it is, we call this, the standard calls it needs to be separately identifiable. And furthermore, when we say separately identifiable means that the performance obligation is not dependent on another performance obligation. It is not an input to another performance obligation. You can sell it, it's separately identifiable. It's not dependent on another. If it is dependent on another, that means it's not separately identifiable. That also means that it doesn't have a distinct profit margin. It doesn't have a distinct profit margin. Okay. That being said, that's the entire story. Let's look at scenarios to drive home the points. Just 3 scenarios. Scenario 1, a construction company, Buildco Limited, signs a contract to build a shopping mall for 50 million. The contract includes design and architectural services, foundation and structure construction, electrical and plumbing installation, interior finishing. So, even though they don't have any requirements, I'm sure that they want us to tell whether each of these services, each of these goods or services in this contract are distinct. So, from what I'm seeing here, I can see that each of them, they are not distinct. They are not for me, because we have design and architectural, foundation and structure, electrical and plumbing interior, and these guys signed a contract to build a shopping mall. So each of these services don't have a distinct function, and they don't have a distinct profit margin because they are so dependent on one another. So the services in the contract are dependent on one another, that you cannot move to the next phase without completing the previous one. Hence, the entire services should be treated as a single performance obligation. So we cannot treat each of them as separate because they don't have distinct function. They don't have distinct profit margin. They are so dependent on one another. You cannot go to foundation and structure if you don't do design and architecture. A friend of mine that tried that, I mean, is the country is not easy. The guy was able to gather money. He bought a small plot in Ikorodu. He wanted to leave rental houses. So he said he wants to build a bungalow and just move in. I told him, get a design. He got an architect. Now says he's going to collect for design for this structural, all of that. They shall build him around 750. When he calculated 750, he saw that that one will finish the house up to roof level because he will buy blocks, cement, and all of that. And it's just bungalow he wants to do. That I should give 750. He said he's not doing. He just called one bricklayer in Adugbo that, oh yeah, be arranging blocks. He did. When they finished, those ones forgot to put toilets in the house. Up to today, his toilet is outside. Anytime he wants to use the toilet, he wakes up, he has to open the door and go outside and use the toilet because he refused to follow the natural process of building. So these steps, when it comes to structure, in this case, they are so dependent on one another that you cannot say you want to benefit from one without considering the previous one. So you're going to see the entire service as a single performance obligation. They are not separate. Another scenario, a software company, TechSoft Limited, signs a contract to provide a software license for 500K, installation and and customization for 100K, 1 year technical support, 50K. So this one now is a little, we need more information anyway. So if the software, if the software license can function without customization, and the customer can install itself, then each service will be treated as a separate performance obligation, Otherwise, the entire services will be treated as a single performance obligation. So they will have given us sufficient details. I mean, I've seen something like this in an ICAN exam. They will give you all the relevant details that the product, the license cannot work unless it is customized periodically, or unless it is installed. And the technical support is also very necessary. And the technical support is also very necessary. So if they say that, then in such scenario, we would see it as a single performance obligation. But if the software license can function, if the software can function without the customization and the customer can install itself, then we will see the software license as a separate performance obligation that we will recognize revenue for it separately. The same thing for the installation and customization and the 1 year technical support as well. Then we'll see them separately as a performance obligation. Another scenario, a telecom provider, Telenet Limited, signs a 2-year contract with a customer. It provides a free phone at contract signing and also charges 18 naira per month for telecom services. For this one now, the phone, the services here is the phone and probably maybe mobile service or network service. That's what they call telecom service. Phone has a distinct function, a distinct profit margin. The mobile service, distinct function, distinct profit margin. They can function on their own with another phone, not necessarily this phone. So the services in this contract can be treated as a separate performance obligation because they can be sold separately. That is, they have distinct function and a distinct profit margin. So we treat them separately. They have distinct function, distinct profit margin. Finally, a pharmaceutical company, PharmX Limited, of PharmX Limited, grants a license for a new drug formula to Biomed Limited. Number one, a 5-year exclusive license to manufacture and sell the drug for 200 million. Number two, ongoing R&D support and regulatory updates for 50 million. So for this one, we have PharmX Limited. It grants a license for drugs, 5-year exclusive license. So for this one now, there are two services here, a license and R&D support. So again, we need more information. So if the license can function, separately without the R&D and regulatory updates, then each service is treated as a separate performance obligation. No, if the license can function, yes, separately without, yeah. So, but however, if the license require the R&D support to function, then we treat the entire service as a single performance obligation. You get the idea here? Okay, so those are just scenarios to visualize what we are talking about when it comes to performance obligation. Either we treat them, whether they are separate, whether they are not separate, it depends on whether they have a distinct function and a distinct profit margin. So if they can function distinctively, if they are beneficial on their own, and they can be sold separately or perform or have their own separate profit margin, then we can see them as a separate goods or services. That's the end of step 2. Do we have any questions on that? Now, step 3.
Yeah, please, can you scroll up? I want to screenshot the case 3 telecom contract.
Why use? Anyway, you can satisfy yourself. But I will still share these notes to the group. But screenshot what you want to screenshot.
Thank you, I've done that.
Step 3 is to determine transaction price. So, transaction price is the consideration is the consideration that is received from the transfer of promised goods or services. So the consideration that is received from the transfer of promised goods or services is transaction price. So it's very important to know that this transaction price must exclude the money collected on behalf of third party. So any money you collect on behalf of third party, that's right from day one, you know that it is not your own. You have to exclude it. So an example of that is VAT. Example of that is VAT. There's this audit I'm doing presently. There's a client of mine, I won't mention their name. So they are like a middleman. If you have, let's say, a warehouse, if you have a boss, they are like logistics, warehousing services is what they do. So they would help you rent that warehouse. They are like an agent. They will help you rent that warehouse to customer. Then they will collect money. Then they will give you your own money. Even if you have a bus, if you have a truck, they will help you rent it. They will collect the money. Then they will give you your own. Then they will give you your own money. So the challenge we have is that IFRS came and said that, okay, the whole money that this company is collecting is their money. The whole money they are collecting is their money, and that they should pay VAT on it. But truth be told, this company in question, when they are billing those customers, they actually add VAT. But I mean, in the middle of it, probably they are not permitting the entire VAT, just saying that that entire money is not their money. That what they actually add VAT on is the service charge on that collection. Is the service charge on the entire sum. I mean, it's a major argument. So the point there is that for that kind of company, the money they are collecting it on behalf of third party. Is the commission that is their own revenue. The commission portion of it is what they should recognize as revenue, because they are still going to give the other money. They are not the owner of the product 100%, so they cannot recognize revenue on that entire money 100%. So transaction price is the consideration you are expecting that you will receive from the goods, from your own goods you have transferred. And this transaction price must exclude the money you are collecting on behalf of third party. So the way some people now treat it, which is wrong, is that the money they are collecting on behalf of third party, they will not treat that as cost of sales. No, that's not your cost of sales. The money is not your money. The money is not your money in the first place. That revenue is not your revenue. That money you are giving to third party is not your cost of sales. The goods is not your own. You are just a facilitator. So all those money you are collecting on behalf of third party is not your money. You cannot recognize it as revenue. Okay, I hope you get the gist anyway. Now,
Hello, sir.
yeah, Ufoma.
Sorry, sir, I didn't understand it because, like, if you're selling a good and you charge VAT on it. So you will not recognize the VAT element. Is that what you're saying?
Yes. Yes, you will not recognize the VAT element as revenue. Are you there? You're not saying you're not
Okay,
recognizing
sir.
the VAT element in your book, so the VAT element would be a liability because you're supposed to pay to the government. You just recognize it as a VAT liability. Okay, so note that transaction price can either be a fixed consideration, variable consideration. So it's not all transaction price that is fixed. There are some that are variable, that would be variable. Or like if you give a discount to the customer, or there's a condition attached that if you do so well, they will give you a bonus, or you give a bonus, something like that to your customer. Those can affect the transaction price. So transaction price can be variable. And within a transaction price, there could also be non-cash consideration as well. So if a transaction price is being settled with other ways like shares, like if you're settling for the goods or services with shares, then those are non-cash consideration. And you remember, we did that in IFRS 2, where we settle goods or services with our shares. IFRS 2 focused on we, the buyer, we, the entity. We dealt with that as a share-based payment and all of that. But the seller will need to recognize revenue. And IFRS 15 says that in that case, you will just recognize revenue at the fair value of that non-cash consideration. So he would not recognize revenue at the fair value of his goods or services. He would rather recognize it at the fair value of what he's receiving at the end of the day. So non-cash consideration. And also, transaction price is also determined by time value of money, because if you sell and your transaction price will be received much later in the future, then your transaction price might not be that future amount. You will need to discount it to present value. And when you're discounting to present value, as you then move through time, you will then need to be unwinding the discount. If you remember what I taught you on provision, you need to unwind the discount as you move through time. Okay, so I think just to see what I'm saying practically, we need to look at scenarios for fixed consideration, variable consideration, non-cash consideration, and time value of money, so that you can easily relate to what we are talking about. So fixed consideration is kind of straightforward. It's just when you sell goods to somebody and the person is paying you a fixed sum. So that fixed sum you're collecting is the transaction price. So that one is straightforward. But variable sum, variable consideration, if you have a scenario where a construction company called BuildCo Limited signs a 100 million contract to build an airport, and the contract includes 10 million bonus if completed within 24 months, 5 million penalty if delayed beyond 30 months. Okay, so here now the analysis will be like, So if the project is completed within 24 months, the transaction price will be 110 million. But if the project is delayed beyond 30 months, the transaction price in this case would be 95 million. So it now depends on which occurrence or which outcome we are relying on. If it's a delay outcome, our transaction price become 95 instead of 100. If it's an early completion outcome, then we'll get a bonus of 10 million. Then our transaction price eventually would be 110 million. So the second scenario is a significant financing component, which is a deferred payment. So we have a machinery supplier, Equipco Limited, sells equipment to a customer for 5 million, but payment is deferred for 5 years at 0% interest. So if you are to analyze this, because payment is deferred for 5 years, so that means this 5 million will be paid in 5 years' time. So the transaction price is the present value of the 5 million, is the present value of that 5 million naira, and at the end of each year, an interest income will also be recognized. So, but the challenge here is this: we will need to determine which discount rate we're going to use to get this present value. So probably we can use an MPR rate, but in the exam, definitely they will give you a discount rate you can use. But what you would recognize as the transaction price won't be that 5 million you're collecting in 5 years' time, but the present value of that 5 million. And I'm sure you can determine that 1 plus r raised to power minus n would give you that 5 million. Then, let's see. Then as you move through time, you will need to be unwinding the discounts as you move through time, so that after 5 years, that present value then should become 5 million in the future, like that. So, but we will need to determine the present value of that 5 million for us to get our revenue. Then at the end of each year, we can be recognizing interest income to account for the time value of money. And the final one, not the final one anyway, there is non-cash consideration. So a technology firm, TechSoft Limited, provides a consulting service in exchange for 1,000 shares. of a startup instead of cash. So in this case, the transaction price is the fair value of the 1,000 shares. So he collected 1,000 shares instead of cash. So the fair value of the 1,000 shares would represent what he will recognize as transaction price. The final scenario here, it says a consumer goods company, Fast Goods Limited, sells product to a retailer for 1 million, but agrees to pay the retailer 200,000 for in-store marketing. So here, transaction price will be 800,000. That is, he sells goods to a retailer. The selling price is 1 million. But now he's agreeing to pay the retailer 200 for in-store marketing. That if the retailer markets his products in his own shop, he would give him 200K. So that means his transaction price is 800,000. Okay, I think I'm tired already, so it just makes sense to stop. So you won't be teaching something else. So I'll give you these as assignments for you to try your hands on determining transaction price. So when we come on Saturday, we're going to finish up step 4 and also step 5. It's not much anymore. Then we are done with step 4 and step 5. Then I will then go into some practical scenarios that was mentioned in the standard. And then we'll then solve past questions. Then hopefully I'll finish it up on that Saturday, hopefully, so that we'll still have to do a similar class we did last week Sunday. We'll do it this Sunday again, just so that we can do IS 10 event after the reporting date. Then if we can successfully crash that, then I'll probably want to teach you guys IFRS 16, which is on leases. Then I can then start group accounts with you guys probably next week. Then we'll then look at which other areas we need to also cover. So let's stop here for tonight. If we don't have any questions, I guess I will see you on Saturday. Any questions? Okay, have a wonderful night. Bye-bye.
Bye.
Thank you.
Good night.
Bye.